Money and finance, foundations, systems, and personal mastery. Money and finance shape nearly every aspect of modern life. From the food we eat to the homes we live in, from education to healthcare, money acts as both a medium of exchange and a measure of value. Finance, on the other hand, is the system that governs how money is created, managed, invested, and distributed. Together, they form the backbone of economic activity, at both individual and global levels. This article explores the concept of money, the structure of financial systems, the role of institutions, personal finance strategies, investment principles, and the evolving future of finance. Understanding these concepts is essential not just for professionals, but for anyone seeking financial stability and growth. 1. The nature and evolution of money. What is money? Money is anything that is widely accepted as a means of exchange for goods and services. It performs 4 primary functions. Medium of exchange, facilitates transactions without the need for barter. Unit of account, provides a standard measure of value. Store of value, retains purchasing power over time. Standard of deferred payment, allows for future payments, such as loans. Historical evolution, money has evolved significantly over time. Barter system, early economies relied on direct exchange of goods, which was inefficient due to the double coincidence of wants. Commodity money, items like gold, silver, and salt served as money due to intrinsic value. Fiat money, modern currencies, such as the rupee or dollar, are not backed by physical commodities but by government authority. Digital money. Today, money increasingly exists electronically, bank balances, online payments, and mobile wallets. 2. Understanding financial systems. A financial system is a network of institutions, markets, and instruments that facilitate the flow of money within an economy. Components of financial systems. A. Financial institutions. Banks accept deposits, provide loans, and facilitate payments. Insurance companies offer risk protection. Investment firms manage funds and provide advisory services. B. Financial markets. Stock markets, where shares of companies are traded. Bond markets, where debt instruments are issued and traded. Money markets, short-term borrowing and lending. C. Financial instruments. Equities, stocks, ownership in a company. Bonds, loans made to corporations or governments. Derivatives, contracts based on underlying assets. Role of central banks. Central banks regulate the money supply and maintain financial stability. They use tools like interest rates, open market operations, reserve requirements. Their policies influence inflation, employment, and economic growth. 3. Personal finance, managing money effectively. Personal finance refers to how individuals manage their money, including earning, spending, saving, and investing. Budgeting. A budget is a plan for how income will be spent. It helps track expenses and ensures financial discipline. A simple framework is the 50-30-20 rule. 50% for needs, rent, food, utilities. 30% for wants, entertainment, travel. 20% for savings and investments. Saving. Saving is essential for financial security. It provides a cushion for emergencies and future goals. Emergency fund. Ideally 3 to 6 months of living expenses. Short-term savings. 4. Goals like vacations or gadgets. Debt management. Not all debt is bad. However, high-interest debt can be financially damaging. Good debt. Education loans, home loans, might be right. Bad debt. Credit card debt, payday loans. Strategies include paying high-interest debt first. Consolidating loans. Avoiding unnecessary borrowing. 4. Investment principles. Investing is the process of allocating money to assets with the expectation of generating returns. Risk and return. Higher returns typically come with higher risk. Understanding your risk tolerance is crucial. Low risk. Savings accounts, government bonds. Moderate risk. Mutual funds. High risk. Stocks, cryptocurrencies. Diversification. Diversification involves spreading investments across different assets to reduce risk. A well-diversified portfolio may include stocks, bonds, real estate, commodities. Time value of money. Money today is worth more than the same amount in the future due to its earning potential. This principle underlies concepts like interest and investment growth. 5. Financial planning and life goals. Financial planning involves setting goals and creating strategies to achieve them. Short-term goals. Buying a gadget. Going on vacation. Medium-term goals. Buying a car. Higher education. Long-term goals. Buying a home. 6. Behavioral finance. Financial decisions are not always rational. Behavioral finance studies how emotions and biases affect decisions. Common biases: overconfidence, believing you know more than you do. Loss aversion, fear of losses outweighs potential gains. Herd behavior, following the crowd. Understanding these biases helps in making better financial decisions. 7. Corporate finance. Corporate finance deals with how companies manage their finances. Key areas: capital budgeting, deciding which projects to invest in. Capital structure, balancing debt and equity. Working capital management, managing short-term assets and liabilities. The goal is to maximize shareholder value. 8. Global finance and economic interconnectedness. In today's world, economies are interconnected. Events in one country can impact others. Exchange rates. Currencies fluctuate based on supply and demand. Exchange rates affect trade, investment, travel, international trade. Countries export and import goods, influencing economic growth. Trade policies and agreements play a major role. Financial crises. Global financial crises, such as the 2008 crisis, demonstrate how interconnected systems can lead to widespread instability. 9. Technology and the future of finance. Technology is transforming finance at an unprecedented pace. Fintech. Financial technology. Fintech includes innovations like mobile banking, digital payments, peer-to-peer lending. These services increase accessibility and efficiency. 10. Financial literacy, a critical skill. Financial literacy is the ability to understand and use financial concepts effectively. Why it matters: helps avoid debt traps, encourages saving and investing, improves financial decision-making. Key skills: budgeting, understanding interest rates, evaluating investment options. Education systems are increasingly recognizing the importance of financial literacy. 11. Ethics and responsibility in finance. Finance is not just about profit, it also involves responsibility. Ethical issues: insider trading, market manipulation, fraud. Sustainable finance. There is growing emphasis on investing in environmentally and socially responsible ways. ESG: environmental, social, governance investing. Green bonds. 12. Practical tips for financial success. Start early. Time is your greatest asset. Live below your means. Avoid lifestyle inflation. Invest regularly. Consistency matters more than timing. Stay informed. Keep learning about finance. Avoid get-rich-quick schemes. Focus on long-term growth. Review finances periodically. Adjust plans as needed. Conclusion: money and finance are far more than numbers. They represent choices, opportunities, and security. From understanding the basic functions of money to navigating complex financial systems, knowledge is the key to empowerment. In a rapidly changing world, financial literacy is no longer optional. Whether managing personal budgets, investing for the future, or understanding global markets, the principles of finance remain essential tools for success. By developing disciplined habits, making informed decisions, and embracing long-term thinking, individuals can achieve not only financial stability but also financial independence. Thanks for listening.